Welcome back. We're still on the various types of financial analysis. In this video, we will be looking at profitability of MSMEs. Profitability is probably the most important financial analysis that must be made to MSMEs because if they are not profitable, they may have to stop their business. What indicators can be used to measure the profitability of MSMEs? They could be things like profit margin ratio and return on total assets. Do you remember this slide? It's a visual image of an income statement. Let me mark A, B, C, D to these items. For each of these items A to D, different costs go into them. For example, take a look at cost of sales. Under cost of sales are raw material costs or salary of workers that work on production. They are all costs to make the products. These costs are also called variable costs because you can adjust the cost depending on how much you produce. If you produce less, you need fewer raw materials and workers working on production. If you produce more, raw material costs increases and you may need to hire more people to work on production. What about administrative expenses? Salary of business owners or secretary, for example, do not change depending on how much product you produce. So these are called fixed costs. Each MSME may categorize their costs differently, and there is no right or wrong answer. For example, some MSME may put all workers' salary into fixed costs because no matter what the production amount, they will not change the number and salary of their workers. Or maybe some MSME would put advertisement costs into variable costs because they may spend more on advertisement when they produce more products. Now that we understand variable costs and fixed costs, let's calculate the profit margin ratio. There are two types. One is gross profit margin and the other is net profit margin. Let us first look at net profit margin. You divide net profit with net sales. If net profit margin is decreasing, the MSME may want to consider cutting variable costs or fixed costs to increase profits. But net profit margin cannot tell you which of the two costs between variable cost or fixed cost is increasing. So you can also calculate gross profit margin. You divide gross profit by net sales. If gross profit margin is decreasing, this MSME knows that the variable cost is increasing. So they may want to think about decreasing variable costs to increase profits. If the MSME knows its total assets, they can also calculate return on total assets or ROA. You divide net profit with total assets. If ROA is decreasing, it means that the MSME may not be using its assets wisely, so they may want to try to increase profits. Now, let's try an exercise. This MSME presented 2 years' worth of income statement and total assets. What is their profit margin ratio and ROA? Pause this video and first create an income statement. Then calculate the profit margin ratio and ROA. More importantly, what do the profit margin ratios and ROA mean for the MSME? Are the figures adequate? Think about what the numbers mean. What was your answer? First, the income statement for each year can be presented as such. Note that in 2011, this MSME's net profit has decreased. After creating an income statement, we can calculate the profit margin ratios and ROA. Gross profit margin ratio is same for both years, but net profit margin is lower in 2011 than 2010. From this, we know that the MSME's fixed cost is increasing. Maybe the MSME needs to consider decreasing fixed costs. ROA is also decreasing in 2011. This means that the MSME's assets are not being used wisely. Now that you learned about profitability, please go to the next video.